Just want to tell you what's happening right now. Maybe we could pull up an intraday chart of the S&P 500, guys, because we saw a little spike up on the economic data that we just got, that Rick just brought us. Worse than expected consumer confidence from University of Michigan. But dig beneath that number, and inflation expectations were weaker than expected. There you see the tick up on the chart when that news came out. Yes, home sales were a little bit better. But I think, Randy, inflation expectations weaker than expected, and that confidence number is key for the market and for the Fed. What does it say to you?
Totally agree. I think the reason that the Fed moved 75 basis points rather than 50 basis points last time is because the previous survey had come out and said that the intermediate to longer run expectations had been moving up much more rapidly than they had done. The 5 and 10 year out expectations had basically been where they had been over the last decade or so. Then they started to break out above that. The Fed doesn't like that at all, because that means that inflation expectations can be unanchored. So that's why they move more aggressively. This is going to be good news for the Fed. Does it mean they're going to stop hiking? No way. But does it mean that they're going to feel a little bit less pressure to go 75 every time? Yes.
So that's interesting, because all we've heard from the chorus of Fed speakers this week is 75 basis points at the next meeting in July. They're working off of old data on the last inflation report and all these credibility questions. But ultimately, what do you think is going to happen in July and then the meetings after that? Bullard said he wants to see 3.5% by year end on the Fed funds rate.
So I think it's most likely that they will do 75 at this next meeting, but I don't think they're going to. If inflation expectations continue to come down a bit, then they don't have to do 75 every single meeting. And that's going to be where what the data look like, what the unemployment rate looks like. Is that going to start to move up a little bit? I know everyone says the job market is so strong and it can never become weaker. I'm not so sure about that. I think at some point it could weaken a bit, and that would also take some of the pressure off of the on the demand side, and so help to moderate inflation.
So, Randy, what's the bigger risk, you think? Going 50 when they should have gone 75 in July, or the other way around? And what's that next metric that we're going to get that's going to tell us if the Fed is hiking too much too fast?
I wish we had that sort of sign inside of the magic ball to be able to answer that, the crystal ball or the magic 8 ball to be able to give you that answer clearly. I think it's important that they continue to work on the be worried about inflation expectations and move another 75. That'll get them pretty far into or close to where they think is roughly neutral. And then that gives them time to think about, okay, now are we starting to see some signs, inflation coming down, starting to see inflation expectations staying where they are, at least not moving up any further. So I think they continue to need to move expeditiously, as Jay keeps saying. But will they need to do 75 every meeting for the rest of the year? I don't think so.
Yeah, but if they continue aggressively and inflation's not coming down, then what? Right?
Well, they were in a lot of trouble, because then they'll have to be even more aggressive. We'll have to be back to the late 1970s. And I'm old enough to remember that when inflation was this high back in the late 70s, early 80s, we had double-digit interest rates. I mean, people can't conceive of that. A mortgage at 12% was a great mortgage. Mortgages are half that right now. I don't think we're going to have to get there. I don't think we're going to need to. But if somehow your scenario plays out that inflation expectations keep moving up, unfortunately, we might need to get there.
Commodities prices are down pretty sharply this week, Randy, and that could be why we've seen a rally for stocks and a rally for treasuries, which are both a sell-off for the dollar, which is extending after this economic data. If you were in the Fed's position and you saw these kind of moves in commodities, how much would you read into it?
It's only 1 week's worth of data. My goodness, we've seen an enormous amount of volatility in whether it's lumber prices or pick your favorite commodities. So I wouldn't read too much into 1 week's worth of numbers. I mean, I prefer, if I were there, I'd prefer them going down rather than going up. But I wouldn't be assured that next week they're going to stay down rather than some other shock coming in and moving them up. And that's why I think they look at things like inflation expectations, because that's really where they worry about in the longer run things becoming more problematic, and that they'd really have to raise rates much more aggressively if they can't keep inflation expectations under control.
Where are you, Randy, on the odds at this point for a soft landing. I think everybody on Wall Street and even the Fed, based on Fed Chair Powell's testimony, agreed that after the last meeting, those odds came down, right? That it was a narrower path to the soft landing. Is there still a shot of that?
There's certainly a shot for that, but even before that last meeting, I just didn't see how the Fed could actually bring inflation down significantly without there also being a very significant slowdown in economic activity. Does that formally mean a recession? That is 2 quarters of negative growth? Not necessarily, but dramatically slower growth than we have now, I think is pretty much in the cards. I mean, they themselves think that they're going to be about 1.5% above neutral. They think of neutral as being sort of in the mid-2s, and they see interest rates peaking in the upper 3s. That means contractionary monetary policy. And then you've got that shock, plus the continuing supply shocks and the problems in sanctions in the Ukraine, war in the Ukraine. It's going to be a really difficult path to make sure that we just have slow growth rather than a little bit of negative growth.